Hello traders, you are welcome back to the Forex Geek channel. Now in this video, we're just going to be breaking down an important trading strategy that can help you navigate sideways markets, and that is price range trading. Okay, this strategy is incredibly effective for those of you who want to understand market movements within specific boundaries. All right, so price range trading is all about identifying key levels of support and resistance. All right, you need to identify key levels of support and and resistance. All right, and using those levels to predict where price will go next. So if you're tired of chasing trends and want a strategy that works in consolidation, then this video is for you. Before we dive in, don't forget to hit that like button, subscribe to the channel, and turn on the notification bell so you never miss out on more trading strategies that can level up your skills. Okay, let's just jump right in. First things first, let's talk about what price range trading is. Okay, at its core, price range trading is a strategy where traders take advantage of price movement within a defined range. All right, traders try to take advantage of price movement within a defined range. Now, this means that the market is neither trending up nor trending down, but instead is moving sideways between key levels of support and resistance. These levels act as boundaries for the price, and the goal is to buy at support, the lowest point of the range, and sell at resistance, the highest point of the range. Okay, the beauty of this strategy lies in how predictable the price movements can be when the market is consolidating. When you can identify a clear price range, you can trade with confidence, knowing that the price is likely to bounce between these key levels. All right, you can see that we actually have multiple consolidation zones, right? But how do you identify a price range and execute trades within it? That's what we'll be diving into next. Okay, to successfully trade within a price range, you need to know how to identify key levels of support and resistance. Okay, these are the price points where the market tends to reverse direction or to pause. So let's just break it down. For a support, right? For a support, this is the price level which demand for the currency pair is strong enough to prevent the price from falling further. Essentially, it is the floor of the range. Okay, so when price approaches support, buyers usually step in, pushing the price back up. Then for resistance, on the flip side, resistance is the price level where selling pressure outweighs buying, creating a ceiling for the price. As the price reaches resistance, sellers often enter the market, pushing the price down. Now, to identify these levels, look at the recent price action. If the price has bounced off a certain level multiple times, that's a strong indicator of support or resistance. Now, a good tip is to use tools like horizontal lines. You can see these horizontal lines, and then trend lines as well. Okay, trend lines also play an important role. All right, so make use of your support and resistance zones, make use of your trend lines, and even Fibonacci. Yes, you can also make use of your Fibonacci levels. All right, because the Fibonacci also gives you possible reversal points. Okay, so all this can help you visualize where these key levels are. So once you have those levels in place, you'll know where the price is likely to stall, reverse, or break out of the range. Now that we know what price range trading is and how to identify key levels, let's talk about how to actually execute trades. Okay, here's a simple approach that you can follow. You can buy at support. When the price approaches the support level and shows signs of bouncing back, consider entering a long position. Your stop loss should be just below the support. All right, the support level to minimize risk if the price breaks below it. Then for resistance, you can sell at resistance. When the price approaches resistance and shows signs of rejection, you can go short. Then place your stop loss above the resistance to protect yourself in case the price breaks through. Okay, remember, the idea here is to trade the range. Don't try to predict breakouts. All right, if the price is moving within the range, just stick to buying near support and selling near resistance. But what if the price breaks out of the range? Let's talk about that, right? Sometimes price doesn't respect the boundaries of the range and breaks out of support or resistance. So how do you handle this? In the case of a breakout, you can see like what happened here. There was a breakout, right? The price moves beyond the support or beyond the resistance, signaling that the market is trending again. So when this happens, you should reassess your position. If the price breaks above resistance, it could be a signal to enter a long position in the direction of the breakout. If the price breaks below support, consider entering a short position. But how do you avoid getting caught in a false breakout? Here are a couple of tips. The first is to wait for confirmation. Okay, do not jump into a trade the second the price breaks a level. Wait for a candlestick close above a resistance or below a support to confirm the breakout. Then use stop losses. Always set a stop loss to protect your trade in case the breakout turns out to be false. Then as for managing risk, always keep your position size in check and ensure your stop loss is well placed to protect your capital. It is very, very necessary. Okay? Risk management is key to surviving in the markets. You might have a very effective strategy. You might be a very good technical analyst, right? You might be very wonderful when it comes to analyzing fundamentals and all of that. But if you cannot manage your risk, you might end up losing a whole lot of money. So that is the reason why risk management is also important, okay? And it is key. It is necessary. It is a must-have characteristic, a must-have attribute if you want to be successful in the long run trading the financial market, okay? Now, to bring it all together, let's just look at a quick example of price range trading in action, right? So imagine you are looking at a 4-hour chart of Euro USD and the price has been bouncing maybe between 1.1 and maybe let's just say maybe between 1.09 and 1.08. All right, the 1.09 is the resistance, 1.08 is support, right? So assume price has been bouncing between those levels for a while. Then you wait until the price approaches the 1.08 support and shows sign of bouncing, perhaps a bullish candlestick pattern. Then you go long, probably some pips above that support, placing your stop loss just below the 1.08 support, right? Then the price moves back upwards toward the 1.09. Then you sell around that 1.09, or perhaps when you get a bearish confirmation, so you can probably sell around maybe 1.089, right? Then you set your stop loss above the 1.09 resistance, probably around 1.092 or thereabouts. Okay, so basically you buy near support and you sell near resistance. This is the essence of price range trading. And that is a wrap on price range trading. By understanding how to identify key levels of support and resistance and executing your trades within the range, you will have a powerful tool in your trading arsenal. If you found this video helpful, make sure to like, subscribe, and hit the notification bell so you never miss out on more valuable strategies and tips. Let me know in the comments how you use price range trading or if you've had any success with it in the past. I'd love to hear from you. Until next time, happy trading, and I'll see you in the next video.